Is this on? Okay, we're good. I'm going to try to start a little bit early because I gave this presentation or parts of it in Toronto just last week, and it's about an hour and a half presentation, and I have about 20 minutes today. So we want to get to those 5 stocks for you, so we're going to go really quickly. Now, I would say, I'm going to start off by saying, if you don't know what Keystone does, then you listen to the radio, listen to Money Talks. I regularly am on that show. I was on last week. We do independent research on individual companies and give these reports, buy, sell, hold reports to our clients. So you subscribe to our service on an annual basis, and we have several portfolios that you can mirror, and we help you build these portfolios with our research over time. We're fundamentally based research company. Now, I'm going to start you today. We recommend you buy between 10 and 20 stocks in your portfolio. Typically, I give more education on how to set that up. I'll give you a little slide on that today, but I'm going to give you 5 stocks to start you off on your journey towards building your own DIY portfolio today. So I'm going to start off by saying, why are we here? Now, I'm not talking about in the existential way, so there's going to be no talk about being born into a cold and empty universe today. What are we here to do? We are here to make money. I do like to educate people. I think an educated investor is a better investor, but because I have 5 stocks to recommend, 4 sectors to go over in only 20 minutes, let's just get to making you some money. Now, we're going to discuss some theme or hot trend investing. We're going to look at these segments from a fundamental perspective. I'm going to put that at the end of the presentation because we need to get to those stock recommendations fast. But we'll be touching on some of today's hottest industries or themes, hot button topics: cannabis, blockchain and cryptocurrency, AI or artificial intelligence, big data, and IoT, which would be the Internet of Things, as well as cybersecurity, which is an industry we can really dig into and fundamentally value. We just made a recommendation in that sector. It's already the best performing cybersecurity company in North America over the past 3 months. What are we looking to accomplish today? Well, our goal here is threefold. We want to separate the legitimate long-term investment themes from the overhyped, misunderstood concept or segments. We're also going to determine what individual stocks will benefit from these long-term investment trends. And we're going to determine, once found, what companies in these segments will actually offer reasonable value. We look at companies on a GARP basis, or growth at a reasonable price. You can find a company out there that is a great business, but if you don't buy it at the right price, you're not going to make money long term. Now, we believe the market is really simple. It's hard to find good companies, but it comes down to the more money the company makes that you're invested in, the better the stock will perform long term. It doesn't have to be more complicated than that. Now, we understand that buying the latest shiny new trend can be tantalizing, and FOMA, there's something called FOMA, or fear of missing out, can be a powerful motivator for investors. But many times, these emotions are driven that can drive you to invest in these companies short term, can lead to poor long-term investments. In the market, it is all about return, not about how sexy your investments are. Now, I'm going to ask for some audience participation here. Ooh, it's not a pop test. Don't worry, you're not going to be put on the spot too much here. But I'm going to ask you, can anybody in the audience here tell me the best performing stock on the entire Toronto Stock Exchange over the past 10 years? Anyone? Don't feel bad. In Toronto last week, I had 300 people in the room. Not a single person can name it. Anybody got a guess? Right here. Oh, he was in Toronto last week or something, or you saw it online. Awesome. The Boyd Group. He spoiled my slide. There you go. You'd think it might be a really sexy business. This company is up 5,700% over the past 10 years, almost year to date, if you look at just September to September over that period. What does this company do? They fix cars, automobile repair. Not sexy at all, but the returns matter. And this is the best performing stock on the entire TSX over the past decade. $20,000 invested in this company 10 years ago would have netted you $1.14 million today. That's an astonishing return. But of course, you're going to say, back in 2008, 10 years ago, we didn't have blockchain, we didn't have cryptocurrencies, we didn't have the Internet of Things. So fair enough. Let's look this year, 2018. What is the best performing non-penny stock in Canada this year? The best performing in the entire country, TSX Venture or the TSX? Anybody help me on that one? I'm going to do the audience participation. Here we go. There's the question. Canopy right here. We got that answer about 10, 15 people said that. It's a good guess. I think the stock's up 126% year to date. It's done tremendously well. This gentleman here got it. He may be a client of ours. I'm not sure. But he is. That's nice. It's actually a company called Expel. Symbol is DAP.U on the TSX. It's up about 390%. So what does this company do? They, and trust me, you're not alone in not knowing that this company exists. There has been no other coverage in Canada on this company, period. We are the only firm that you would have gotten this research on to buy this stock this year. So what do? They provide and install automotive film that helps prevent those annoying little scratches and dings you get on your car. Again, absolutely a boring business, and if the CEO was here today, he'd be kicking me for saying that, but what is sexy is the returns. In tremendous increase in terms of growth in revenues and cash flow over the course of this year. The first quarter, for example, last year at this time they earned 1 cent. They earned 7 cents. The next quarter, last year at this time they earned 2.5 cents. They earned 9 cents. So what you can see those step-ups right there, the two step-ups in the chart, those are when they released their first quarter this year and then their second quarter. Driven by earnings, I can value this business. We just put out an update on the company, and we're still buying a half position here after the stock has gone up around 400% on the year. Now, oh man, this is a lot of our audience participation. I'm going to ask you a question here. Name the worst performing, one of the worst performing stocks in Canada this year. I'm going to give you a hint. It is one of the biggest names. It was the biggest name, worth $1.1 billion in terms of market cap in the blockchain sector. Cryptocurrency miner. Anybody right here? Oh, yes, you guys are so much better than Toronto. I have to tell you that. Nobody got any of these. We got 2 people getting them. That's awesome. Hive Blockchain. I'm not saying this is a poor company or anything like that. I'm just saying this is what it's done this year. And it's a cautionary tale. At the start of the year, even in September when we were here last year, we had people coming up to our booth. What do you have in cryptocurrency? What do you have in blockchain? Please recommend us something in that area. Not a single company was profitable in this sector. Hive is not alone in this segment. The entire segment, we've done a review of all companies in North America, is down on average 75% this year. Hive is down 82%. That is a great way to destroy your capital long term. Expel is a company that we recommended here in this same speech last year at $1.45. Not sexy, but makes you money. To me, that is sexy. Now, and I'm using the word sexy in an inordinate amount. I've just realized that, but it works for me. What are we looking to accomplish today? What we'd like you to do is begin looking at stocks as if they were a business, not just a symbol. It's the way to invest long term. Stock is an ownership or interest in that underlying business. I think we all know that, but sometimes we forget it, and it's good to be hit over the head with it sometimes. Invest like you were an owner. If you were going to buy a pizza joint on a corner next week, what would you do? You wouldn't just take the name of the company or the stock symbol, for example. You'd dig into the fundamentals. You'd look, is there a bunch of debt in this company? Is the company making money right now? Is it in a good location? So is there growth going forward? Look at stocks like that, like an ownership position in a business, and it'll serve you well long term. Make sure there's profitability as a minimum criteria from operations. We believe that's the way to look at a business. Why did we not recommend any of those crypto miners or anything at the start of this year? Not a single one were profitable. They may become profitable, and then we can look at them. But if you don't start with that profitability, you have a chance of having a loss like we saw in that company over the first, the year to date in terms of Hive. It's just nothing to support that business. When we look at Expel, when it jumps up like that, the other thing is when you have a stock that has no underlying fundamentals really, it's hard to value as it goes up, so it's hard to know when to sell. We can know when to sell. If Expel trades at 50 times earnings, we're going to move out of that stock. Right now, it's still trading at 15 times next year's projected earnings, despite being up 400%. So we can value it still. Now, this is what I call diversification. This is what a lot of investors do. If you add any more than 20 individual stocks to your portfolio, you can see by this chart, you are not getting any benefit from that diversification that you need within a portfolio. You don't want to have 2 companies, but you don't want to have 50. So we would recommend, like I said, between 10 to 20 very high quality stocks to put them in your portfolio. Now, why does the financial industry over-diversify? Well, one of the things, why do they put you in 5 to 20 mutual funds, each of them holding 100 to 200 individual stocks? Well, they can charge you more fees, and we think that's disgusting, and we think the way the industry is set up is not the way to do it. They also do this. Warren Buffett was quoted famously of saying that diversification is protection against ignorance. It makes little sense if you know what you're doing, and it really rings true. A lot of advisors out there, we believe, do not know what they're doing, and it is for their protection, not your protection. So what's our solution? Take control of your portfolio. Create your own simple equity portfolio. Use our research, use someone else's research that you're comfortable with, and create a portfolio like this. Focused diversification, 10 to 20 stocks. If we pick 10 as an example, start with an equally weighted portfolio, 10,000 in each, setting you up well over time. Select stocks from a variety of sectors. You're not going to buy 10 energy stocks. You're going to buy from a diverse set of segments and all profitable businesses. Now, not all of those companies will perform well. If you use our advice, I can almost guarantee you that 2 or 3 of the companies will not perform as we had hoped they will perform. Now, if 2 perform average, 2 well, and 2 excellent, your overall returns over time, we believe, will best the market. We've done that in the past. Can't promise that in the future. Anybody who says they can promise that, walk out of the room, because it's impossible. But we'll use the same methodology that we have in the past. Build it and manage that portfolio. Build it over a 6 to 18-month period. If you ask me right now, give me 10 high-quality stocks to buy, I can't give you that. But if you take our research over a year, I can find you 10 high-quality stocks to add to your portfolio. So patience is key as well. Why small caps? Warren Buffett, we're going to quote again, very instructive on this. When he started in the business, he was asked if he had just $1 million to invest. Just $1 million is a little amount for this man, but he said, how would you do it? It's very instructive, his answer. What type of companies would you invest in? He talks about being in smaller companies that major institutions, including Berkshire, his massive holding company, can't even touch. That's what he started off investing in, and that's where he had his great returns. This is an area where you actually have an advantage over Warren Buffett. It's hard to even hear that, but you have an advantage over Warren Buffett. You do not have advantages over him in any other area, basically, but you do here. Let's take advantage of that. Here's an example of a company that meets our criteria. Software as a service company. Payroll, it yields about 3%, pays a 3% dividend right now, trades around $12.45. What does the company do? Mission critical software for nonprofits. So it provides HR software on the back end, accounting software, all of those very necessary software tools that these companies need. 65% of their revenue is SaaS, so recurring model. It helps us be predictive going forward. We like models like that. Why do we like it? Well, it has a great balance sheet. $30 million in cash on the bank. That's $1.33 per share. So I take that off of the $12.45 when I do my valuation on the company. Strong track record of revenue growth, EBITDA growth, cash flow growth, all the things we like to see. And it has low relative valuations. So growth and at a reasonable price. This is a company we've owned since it was trading around $7.50. It's done well for us over that period. We think it's one of the lowest priced SaaS companies in North America. The company doesn't talk to the market a lot, so we get to buy it at a discount. Eventually, it gets recognized. You can see here, compound annual revenue growth, 5 years, 29%. Accelerating going forward is what we like. Adjusted EBITDA on a per share basis. Over the last 5 years, compound annual at 24%. This year, over the first 6 months, at 36%, accelerating. We like that. Priced to $12.65, like I said. So 82 cents adjusted EBITDA is what we're kind of looking at, adjusted earnings. 15.5 times. In the US, if you're looking at any SaaS company, it's between 30 and 50 times, so we're buying it at a discount. I don't expect it to get to 30 times, but even if its multiple went up to 20 times and it grew, you're gonna have a good return over the course of a year. I think the fair value right now, I think it's actually worth $16. So it has a jump from where it is now to that. You're gonna get paid 3% to hold it. Every year for the past 5 years, it's upped its dividend. We expect it will this year again. That's a profile of a company we like to invest in. I can take some questions right after. I'll step off, but I've got a lot to go through. I'm sorry about that. Viamed is another company we like. Picked up coverage in May at $3.90. Trades at $5.90. We think it offers good value. No dividend, doesn't pay one. It's growing. It's a home medical equipment company servicing an unfortunate growth industry in the U.S., COPD, or chronic obstructive pulmonary disease. They provide ventilators for end-of-life patients. Play on an aging demographic. It has tremendous organic growth. And when I say organic growth, I mean it doesn't have to go out there, issue shares to grow its business. It's growing from cash flow. So fundamentals, revenues in the last quarter up 42%, tremendous growth. Adjusted EBITDA up 71%, tremendous growth there. Valuations 9 times enterprise value to EBITDA. We think it's worth 12 times. You know, that would get you somewhere a target price in the $8 range from where it is now. A solid return from here. We think it continues to grow at 25 to 30% for the next 3 years at least going forward. Next company, well, we talked about this already. How can you recommend it again? Well, the first company we talked about, Boyd, we actually recommended 25 times over the past 10 years. If it's a great company, we'll continue to buy more as long as the financials underlying it are good. So .U denotes that it trades in US dollars on a Canadian exchange. So it's unique in that respect, but it offers actually exposure to the US dollar if you want that as well. No dividend, growing tremendously, just under $200 million market cap. What does the company do? We talked about that. Puts a film on cars to stop annoying scratches and dings. Yeah, but it makes a ton of money doing it. That's what we need. Now let's look at the fundamentals. Look at the revenue growth we saw in Q2, up 70%. Earnings up to 9 cents from around 2.5 cents in that period. I got 5 minutes, so I'm going to really kick it into gear. 42 cents per share we estimate this year. 16.5 times earnings. The market itself trades at 18 to 20. This stock is up almost 400% this year and still could be seen as a value. That was very good value when we originally bought it. It was trading at a very low multiple at that time. Questor, this one we classify as higher risk. It has a spec buy on it. Good underlying numbers. 222 is what it trades at. Yield is nothing, doesn't pay a dividend. Just under 60 million market cap. What do? They have a technology that incinerates methane at a well site. It's basically a company that reduces emissions, and it's a huge problem in the U.S. around all the shale gas plays. This company has a solution. It's based in Alberta. Tremendous business. They can't do business in Canada because it's hard as hell in this country to do business in the patch, but they can do it down there. Fundamentals: 6 months revenues up almost 70%. Earnings were up 200% to 15 cents per share from 5 cents. That's what we like to see. No debt, 4.8 million in cash in the bank. Valuations, we think it'll earn 29 cents this year. So like I said, it's trading at 222. It's well under 10 times earnings. This is an aggressive target, but at 14 times earnings, it would be $4.10. Now we're going to get into this if we can, these sectors. We did a complete sweep of all 109 TSX and venture listed companies on the cannabis or in the cannabis sector. Only 40 had revenues per quarter of over 100,000. Only 14 had revenues of over $1 million per quarter. None of them are profitable. There's some accounting profitability, but that's on revaluation of inventories. Operationally not profitable. Of course, all this can change when we have legalization. We have a box that we stay in. If we don't have current profitability, we don't tread in that segment. We just did a report that reviews every company in this. If you want it, you can come to us and talk to us about it. I think they're either offering it then or is there some kind of way to win it or something. I'm not sure. I don't handle that side of the business, but it's a great report. It's 150 pages on all these companies. There's a great opportunity here, emerging industry, attractive growth. We don't know what's going to go on exactly with edibles. top players in the industry have your first mover advantage. There's some supply uncertainties. Cannabis is actually easy to grow. I don't know if anybody's aware of that. Some of the dumbest people I know seem to be able to grow it very easily. And they can't grow a tomato. So it's great to see that it is, but that says to me, will it be just on the producer side, will it come down to low cost of production? Well, the first movers, like the Canopies of the world, are the ones you'd have to look at there, although they're trading with market caps of 15 billion, and Canopy's 270 times sales. When we bought Expel, I think it was 1 time sales. So, and we can't value it on earnings. So, it's something to take in consideration. Not saying this isn't a sector you can play, but you're playing it with risk capital other than investment capital. Cryptocurrencies. Again, we did a sector breakdown. All companies in North America, there's 14. Just 2 with on quarterly revenues of higher than $1 million. 0 are profitable, so none would pass our criteria. We avoided this sector and avoided those losses at the start of the year because of the fact that they just don't meet our criteria. We're watching all of these companies, and when they get beaten down and some of them get profitable, we will have a great chance to buy them. In Expel's case, the company that was up 400% this year, we watched it for 4 years before we bought it, and it finally came into a range and hit an inflection point that we liked. We may do that with some of these companies, but just know our eyes are on them. Those are the top crypto mining companies. I mean, all of these had market caps significantly higher than this at the start of the year. There's your chart for one of the hut mining. Hive, there's Hive's chart. We already saw that. These are ugly. This is just random charts from the industry. These are all crypto miners or cryptocurrency related companies since the start of the year. Again, ugly. I don't want to see that. Now, it's early stage, volatile, highly speculative. None of them meet our criteria. We continue to monitor it. Blockchain, 35 companies. There's a little more to dig in here, but that's my time today. One sector we could dig into was cybersecurity. We just issued a buy here. This is the company we bought, one of the largest in North America. We bought it just at $61 3 months ago, trades at $90 now. That is an industry that we can value. That is the way we play these trends. I'd like to thank you. If you got any more questions, I'll go back to the booth. It's right there, and I'll answer any of them there. Thank you, guys. Thank you very much.